All right, welcome everyone to the January 2026 edition of the Clear Vista Financial Perspectives. And just want to say Happy New Year. We're in 2026, hard to believe. I remember a long time ago when we were celebrating 1976. I almost said 1776, but 1976. This year is the 250th anniversary of our country. So we're excited about that. And if you don't know me, I'm Mark Trice, and I appreciate you taking the time to join me today for our monthly market update webinar as we kick off the new year. As always, we're keeping a close eye on what's happening in the markets and in the economy. We'll walk you through what this all means for you, your investment, your financial plan, and just your peace of mind. So let's go ahead and get started. On today's discussion, we're going to give a market recap for really 2025 and then also what happened in December. We'll talk a few things about the economy and the current state of the economy. There's some mixed messages that are going on with that, and then we'll talk about the impact to your portfolios. As always, you can send us a text live throughout this webinar to 254-282-0495. That's 254-282-0495, or you can send us an email at info@clearvistafinancial.com, and we'll answer them as best as we can during the program. Okay, so let's jump into the market recap. We'll need to advance there a couple of slides. Okay, and so for the month of December, it was really a slightly negative month. All the momentum that we had going into the first part of the last quarter of 2025 kind of went away with some uncertainties. Both the S&P, the NASDAQ, and the Russell 2000 were negative for the month of December. I would really call it flat just because we had a lot of volatility during that time. So let's take a look at the performance for the indexes for the year. Now the S&P was up 16.3%, and this happens to be of the last 3 or 4 years since the pandemic. This was the slowest year for growth in that time frame. NASDAQ was up about 19%, the Russell 2000 up a little over 11, and treasuries were basically flat, the long-term treasury index. We'll talk about the yield curve in a moment. The moderate index, which is a number of our clients are that's our benchmark, it was up about 9.8%. All right. So I have to give a disclosure here. Please read that carefully. There will be a quiz at the end of today's program, so make sure that you memorize that indexes are not actual stocks or things like that. So let's take a look at volatility. Volatility shows we're going into the month of January, and typically most years we'll have a little bit of a Santa Claus rally, and that supposedly is mythically an indication of how the following year will go. Well, last week between Christmas and New Year's, it was actually the market was down. That's not a foolproof way of saying how the year's going to go, but we generally see more volatility in the early part of the year, especially the end of January, February, and part of March. If you remember last year, from February through April, the market went down almost 20%. But it recovered dramatically in the last part of the year. So this is a chart showing the seasonality of the S&P 500, and that's what we call our volatility index. And the yellow arrow shows you we experience increasing volatility as we go throughout the month of January. All right, let's go into a little bit of an economic update. Let's jump into the Fed. And back in December, the Federal Reserve delivered another quarter-point rate cut, but remains cautious looking ahead. Their predictions were that there might be 1 or 2 more interest rate cuts in 2026. They still expect to make a few cuts, but we don't know when those are going to come. The Fed is scheduled to meet again here this month towards the middle of January, but we'll have to wait and see. A couple of things that the Fed acknowledged, and that was that the labor market is cooling. We're going to show you some data in just a minute. And another shift is the Fed's going to begin short-term treasury purchases to right-size the balance sheet there. So let's go and look at the yield curve. This was as of the end of December. Now this is a pretty healthy looking yield curve. We expect to see shorter term rates on the left hand side of the chart to be lower than those on the right hand side of the chart. But we've seen treasuries, the yields stay flat for some time. That's going to be, I think that will continue for some time. Now, let's talk about the consumer price index. Now, with all this data that we're talking about today, remember the government was shut down for 49 days. And so they're catching up. All the different government agencies and things are catching up with their data. So really the middle of December, we got 2 months worth of data. And my interpretation was, don't even really pay attention to it, because they rushed to get things done. I think these will be revised as we go into January and February. But the October CPI data was limited because of the government shutdown. And the comparisons we really look at when they release that data is relying on 2 months trends. So even with that disruption, the November report was better than expected. Inflation just rose 0.2% over 2 months. Now that's really good. Year over year inflation, this is from that time last year to this time this year, rose only 2.7%, and that was well below the forecast of 3.1%. And the big thing is the core inflation, those things that they see as the core for price indexes, core inflation only rose 0.2%. And that annual inflation of core inflation slowed to 2.6%, and that was the lowest since 2021, right before we started getting all sorts of stimulus checks. Okay, now housing rents is a major inflation driver, and that's beginning to lose momentum. Rent inflation is running about 1.6% annualized, and several other categories are now seeing price declines. Airline tickets and things, airlines fell 6.6%. Hotels, apparel, and auto insurance also declined. From a big picture view, money supply matters more than tariffs. Tariffs do shift prices around, but they don't drive overall inflation. I think that's some misnomers that are being put out in the media. Slow money supply growth supports continued disinflation, and we saw that. Now, we haven't seen the money supply report. That's the M2 for you economy nerds out there, but we haven't seen the report for December yet. But in the October and November, we were seeing the money supply growth slowing, and that will continue to support this lowering of inflation. The labor market remains stable. There's not really any widespread signs of stress in that line. We're seeing inflation pressures are easing, and that's going to support a more stable economic and market environment. Okay, so let's talk about employment. November employment was actually a lot hotter than they thought. 64,000 new jobs, but prior months were revised lower. When combining October and revisions, total payrolls were down about 74,000 since September. So that's kind of weak when it comes to that. But the weakness is mostly government related, not private sector stress. Federal payrolls declined again in November and October, and government job reductions have driven most of the recent headline softness. Private sector growth, job growth remains pretty solid. Private payrolls rose 52,000 in October and 69,000 in November. Civilian employment rose to 96,000 in November, reflecting a lot of the smaller business activity there. The unemployment rate ticked up to 4.6%, but for a healthy reason. The labor force grew by 323,000 people, meaning more people are actually working or seeking work. And this has been a thing we've talked about on previous podcasts about the number of, especially adult men, that have just decided to get out of the workforce. So anyway, the bottom line is job growth is slowing, but not breaking. Okay, and with private sector resilience and wage trends supporting a stable economic outlook. Those are all good. Let's jump into retail sales. October had a soft headline, but the underlying details were a little bit stronger. Overall sales Retail establishments were up 3.5% year over year, and sales rose in most major categories. The one big weakness that was there was largely auto related. People are buying fewer cars. Auto sales fell 1.6%, but that was after the expiration of the EV tax credit. And you've noticed since then, some automakers are not going to be making electric vehicles anymore. What comes to mind was the Ford Lightning. I think they're not even going to manufacture anymore. All right, so online and non-store spending picked up in October. Core retail sales were strong in October as well. So this is a good trend indicator here that people are still having confidence. They're spending money. Sales during the Christmas holiday, I think, are going to come back pretty strong as well. So let's look at the gross domestic product here for the third quarter. We don't have fourth quarter data yet. We'll get that towards the end of January. Q3 was strong. The headline 4.3% slightly overstates the underlying momentum, but we focus really on the core gross domestic product. Consumer spending, business investment and housing. Core GDP grew 3% in Q3 and 2.6% year over year. And so that's pretty close to our economy's pre-COVID trend. Even on a headline basis, real GDP is up 2.3%. That's in line with long-term growth, not an overheated economy. That growth was achieved despite inventory declines. Remember before the tariffs, everyone was worried that tariffs were going to mess up everything, so they started importing large amounts of inventory from overseas. So those things are beginning to decline, and we're seeing that growth be healthy. Business investments also improving. Corporate profits are remaining strong. Profits for corporations rose in Q3 and are up solidly from a year ago. However, valuation and policy risk remain. Elevated interest rates suggest that equity markets are fully valued and they may be overvalued. Inflation remains above target, but that's calling for the Fed to have some caution on further rate cuts. Bottom line is, economic growth is solid and sustainable, but inflation and interest rates still matter for markets. Home sales, small gain in November. We normally see home sales slow down a little bit in the fall, but that was reaching a 9-month high. So even with that 9-month high, overall activity remains historically low. Sales are well below pre-COVID norms and pandemic era levels. And the reason for that is, guess what? Interest rates are higher. Not many of us want to sell our home where we have a 2 or 3% interest rate for one that's around 6. So we're not moving as much as we would normally do. But the inventory is gradually improving. The months of supply of homes across the United States held about 4.2 months of supply. That means that based on the current sales rate, there are 4.2 months of supply in the market. That's still well below the 5% level that's considered a balanced market. So, existing homes also face competition. There's a lot of new builds around, and builders are offering incentives to keep their inventory moving. So we expect a gradual uptrend in sales heading into 2026, but the bottom line is housing is going to remain constrained. Conditions are slowly shifting in a more favorable direction. We'll have to see what 2026 brings. So let's talk a little bit about the markets. Now, we gave you the performance numbers just a moment ago, but you can see here's the sectors that returned last year and what their returns were. The overall highest growth sector in the markets were commodities, driven largely by gold and silver. The second one was technology and really into artificial intelligence. And so those trends are what we expected there. But gold has taken off quite a bit last year. Probably most of you own some gold in your portfolio, especially if you're a client of ours. But you don't want to overweight into commodities because that is a very volatile type thing. AI is the trend. We'll have to see if that continues on. Technology is a big driver of that, and a lot of that is largely artificial intelligence. I am a real person, so sorry we're not there yet. Let's go on and see, because this is an election year. Yeah, it was just a while ago we had a presidential election. Now 2026 will be the midterm elections. Typically in midterm elections, the presiding party in the presidency loses seats in the Congress in a midterm election. That's the typical. Will we have an atypical year? I don't know. But what about how markets behave during midterm election years? Typically, you can see the non-election years there in black. That's the average since 1933. This is for the S&P. And then in presidential election years, markets tend to do a little bit worse than that. And in midterm elections, markets have their lowest level of performance. Now notice here, you go over to the second half of the graph over there, you can see this is when we exclude 2002 when the market crashed, and 2008 when we had the great financial crisis. Those were different scenarios there going on in the economy. But you see midterm election years typically have a lower performance in the S&P and a little bit of a drag on the markets overall. Okay, I think I showed this last time. This is the point here is we want to make sure that we're staying invested over the long haul. Yes, we may want to adjust in things over time, but I graduated in 1989, so this is why this chart is important to me. If I had just put $1 into the S&P 500 in 1989 when I graduated, it would be worth $42 now. Okay, so if I had $10,000, you can extrapolate even more there. The point here is we invest for the long haul, not for the short-term hit and the big bang buck, because that volatility will return and you will lose your money potentially. So this is just a little historical look here. So what do we think about 2026? Let's jump ahead and talk about that. The growth in 2025 surprised a lot of people, but valuations, that's the price to earnings ratios, are really stretched. We do have some tailwinds from additional deregulation, the tax cuts that were stabilized back in July, the amount of AI investment, but some headwinds might be the slower money growth or consumer strain, could be a larger global slowdown. The economy remains divided by income and asset ownership. Yes, there is a big disparity between the high net worth individuals and people that are middle America. And that has continued to expand, that difference has continued to expand over the last 2 decades. This is not a Democrat versus Republican type thing. This is something that's going on that we have to address. As I said earlier, markets remain expensive relative to earnings and gross domestic product. So the base case in 2026, this is according to First Trust and some of the research that they do. This is one of our investment managers we use from time to time. They're expecting about a 2% growth and 2% inflation in the GDP, and the S&P will be closer to 6,000 at the end of the year. So the S&P now is like 64 something, so that indicates a little bit of a decline, but we're not seeing a whole lot of growth in the markets in 2026. We could be surprised, but we're just talking about, on this slide, just the S&P. Opportunities are going to exist, but discipline matters more than momentum right now. So our approach is be selective, diversified, and flexible. Always be flexible. So what does this mean for you? Talk to your advisor. If you don't have an advisor, please make arrangements to engage a financial advisor that can help you. You need someone to help you navigate the economy and review your financial plan. If you don't have a financial plan, or you've never really heard that word before, you need to get one. The big thing is, no matter what happens in the market, don't panic. make sure you're focused on your long-term goals. A one down year or one up year is not going to mean success or no success for you and your financial plan. We expect these and we plan for these things all throughout your adult life and your investment life. The main thing is we want to make sure that you're avoiding decisions driven by headlines. And believe me, if you go on social media, you're in trouble because the headlines are driven by algorithms and artificial intelligence, and they know what to do to stir you up and get you mad. Don't pay attention to that. You just need to stay informed to the issues, and we try to help our clients stay on top of the issues. We're going to let you know about the things that are important to you and what to do about it. Okay, what about my retirement? Am I still working? Give us a call because we have things we can do to help you with your 401k at work, to help you understand your options and navigate those markets. We've got some additional tools out there that can help you make those selections so that you are making the right choices for you in your what could be your largest investment beyond your house. Okay, give us a call, talk to a professional. If you've got a financial plan, it's time to go check in with them. And more importantly, educate yourself. I encourage you to take a look at our YouTube page. We have lots of educational videos there, and I'll put those up in a moment on the final slide. And as always, you can send us a text question at 254-282-0495. I am not seeing on the chat line if you have it, send it to an email. We'll get back to you in just a moment. Go ahead and go to the final slide there. Check us out on YouTube. That is just Clear Vista Financial. And you can look for the Spend Life Well show. We have weekly podcasts that we post, and we have a lot of topic libraries that you can use. Or just visit us on our website at clearvistafinancial.com. And as always, you can schedule an appointment with me online at calendly.com/Mark Trice. So, as always, if you've never met with us before, we offer a complimentary consultation. We'd love to get to know you and learn how we can help you in your financial roadmap for the future. So thanks for listening today and participating in this month's market update. Until next time, hope you have a wonderful month.
Securities offered through Cambridge Investment Research Incorporated, a broker-dealer, member FINRA SIPC. Advisory services through Cambridge Investment Research Advisors Incorporated, a registered investment advisor. Cambridge and Clear Vista Financial are not affiliated. Discussions in the show should not be construed as recommendations or investment advice. Always consult with your investment professional before making important investment decisions.